Stocks are rallying to kick off the new month of trading. Our next guest says it's time to bet on this year's market losers as we look ahead to the new year. Let's bring in Jonathan Krinskey of BTIG. Welcome back. Okay, so then you think this broadening out has legs?
Well, Scott, we were on with you about 2 weeks ago talking about the rotation we thought that was going to happen from mega cap tech into small caps. And, it's been subtle so far. Over the last 2 weeks, I think small caps are up about 3%. Mega cap tech's, flattish, maybe up 0.5% or so. And you're starting to see that broaden out there, right? So regional banks up 5% today. The REITs, just some of the absolute worst areas of the market are really starting to outperform. And, in some cases starting to break out of small bases or even medium-term bases. So, we think it's kind of a double-edged sword, right? Because on the one hand, it's nice to see breadth broaden out, and we want to participate in some of those areas that are playing catch up to the upside. On the other hand, we're also starting to see some of the froth and optimism come back, as represented. The meme stocks are having their biggest 15-day rally since January, and some of the more speculative stuff is starting to really go to the upside. So it's good on one hand, but we're also medium term also seeing that as a bit of a yellow flag as well.
Yeah, but I know you're referring to things like the ARK Innovation Fund, which I believe just had its best month ever, which really isn't a surprise given the dramatic move that we had in interest rates. And as I said earlier, bonds just had their best month since the 80s as rates have collapsed over the last 30-day period. Do you think the broadening, though, in the areas that you mentioned is sustainable? Because that's going to really answer the question of the durability, in some respects, of this market, not just over the next 4 weeks.
I think ultimately we don't think it's sustainable. If you look at even the data today, slowing in the ISM, right? So I think, right now the market's in that, a lot of people have used the Goldilocks period in between when the Fed is done raising but hasn't yet cut. And so, we think this speculative part of the rally can continue for a bit. I think as you get into next year, that's when you're going to start to see the flip of where bad news becomes bad news. And ultimately, that's going to be an issue for most stocks broadly. But I think right now it's all about the rotation. We're seeing a stalling in mega cap tech and FANG stocks, Mag 7. I think that has a bit more to go on the downside. But to your point, ultimately it's seeing the absolute worst, the junk, if you will, rally like it is nice if you can participate. But ultimately, it's probably not the best sign.
Are you negative on the market for next year?
I think if you think about where the data is going and ultimately what that means for stocks once we get past this Goldilocks period, I do think it's going to be a headwind. Again, you're also seeing the crowdingness, whether you look at institutional or retail side of things. The top 7 names are at, in some cases, historic highs or multi-year highs relative to the portfolio, and so that's another headwind for next year. But we're taking it one step at a time. I think right now our conviction is that you want to stick with this relative trade. So regardless of overall market direction, we think small caps over large for the foreseeable future, and then we'll see how that transforms as we get into 24.
But one comment you just made, if you look at where the data is going, those were your words. People who are bullish would say, I am looking where the data is going, and the data looks just fine.
Well, what happened today with ISM?
Well, it's like one report, but there are other reports that have certainly pointed to an economy that's performing just fine in the same sense that inflation continues to come down. Nothing is screaming economy slamming on the brakes by any stretch. I know you would agree with that.
Yeah, no, for sure. And I think that's why you're seeing the risk rally right now, right? I mean, the whole rally that started off in November was predicated on some weaker data, and therefore the Fed might be closer to being done, right? So that's why you get these Goldilocks rallies. And look, the soft landing can't be disproved at this point, which is why you're seeing now some of the riskiest parts of the market start to rally. So again, it's one of those careful what you wish for moments, and like we said, the double-edged sword. We'd also highlight from on the sentiment side of things, you look at something like the AAI bears fewest amount of bears since January 2018. Put call ratios are back to lows we've seen this year. So, people are getting on board with this, and that can persist for a little while, but ultimately, as we get into next year, I think that'll be a headwind.
What does the VIX at 12.6 do to you?
Well, look, the VIX typically on a seasonal pattern tends to bottom in late November, and you actually do see a bit of a rise in volatility into December. So we think we'll get that again once we get through this kind of rotationary period. The VIX is also, it's funny, it's mean reverting until it's not, right? So for most of this year, 13 VIX was a place to sell stocks. You could look back to 2017 when the VIX was routinely below 13. So, it's kind of one of those situations you can view it either way. We think volatility ultimately will rise next year, but for other reasons simply than just the VIX is being low.
Good weekend. Thanks for being on. We'll see you soon.